We have two themes this morning with William Lee. Bill Lee is chief economist at the Milken Institute, preparing for those important West Coast meetings. We must get to California and the San Francisco Fed with Dr. Lee here. But first, Bill Lee, on China as well. The last time you were on, you partitioned to China of domestic economic resurgence and their foreign effect as well. Is that still a two-part discussion?
Oh, Tom, is it ever? The latest PMI numbers show that the boost to Chinese activity is coming mainly from the non-manufacturing sector, both construction and the service sector. In fact, the momentum in manufacturing has eased off because exports have eased off. The global economy just isn't recovering enough to boost the Chinese manufacturing sector back to where it was in the pre-COVID kind of trajectory. But and China's policy has been oriented toward boosting domestic consumption, and looks like this rebound in from the COVID lockdown is part of the down payment for that. The real question is, will this sustain itself? It's easy for every economist to say, oh, we're going to have a strong China right now. But, it's not going to be sustained unless we get income and we get property market settlements. And right now, those are still in the doldrums.
That's where I wanted to go. The solution always is A, keep the people employed in China, and B, always heal that real estate sector, which is so important for some form of individual investment as well. Is that occurring right now? Are the people employed, and is real estate healing?
The private sector in China is very reluctant to invest and employ people. Right now, the biggest problem is that the college graduates are not finding jobs. So you have youth unemployment rate in the double digits, like almost 15, 20%. And more importantly, innovation. Are we going to get the kind of innovation out of the Chinese technology sectors to be able to offset some of the trade restrictions? And right now, China is trying to boost that kind of research, but they also have reorganized government to change governance in a way that controls innovation. The governance structure now is that the ministries and the regulatory agencies are now all under the control of Xi Jinping. So that gives you a warning sign that says innovation will be for the benefit of the center. And Xi Jinping told us that in a speech in Shenzhen a year ago. So the fact that they're controlling innovation means that they may not get the kind of technological boost to improve productivity that they so desperately need, given that they have a declining population.
Bill, it seems like it's not a clean recovery story. It's a muddle, which means that people can kind of shrug it off and in their narrative whack-a-mole moment that we're in, move on to other things, whether it's the banking issues or whether it's just how long central banks can raise rates before things break. Bill, do you think that that's appropriate? Do you think that it has faded into the background? And really the preeminent story here is the consequence of how quickly central banks are raising rates.
I think the biggest source of policy error right now is for the Fed to worry about what's happening to a couple of bad banks and the runs that are associated with badly managed banks, and to ease up a monetary policy. Conflating these two policies will cause the Fed to really miss the boat in terms of getting inflation under control and conflating a problem of bad supervision with financial stability. We don't have financial stability risk. We have a lot of badly managed banks that are being sniffed out by the markets right now. And the case in point is Silicon Valley. The San Francisco Fed and the bank supervisors have completely fallen off the boat in the sense that Vice Chairman Barr told everyone, we gave them 3 notices that they had to fix their governance structure, they had to fix their risk management, and they completely ignored us. Right. What does that tell you? That means we've got a broken supervisory system, not lack of regulation.
Okay, Bill, this is a really important nuance. Was it that state of lack of supervision or below average supervision, but was it overwhelmed by the rate of change of monetary policy?
It would be a nice narrative if that were true, but we don't. We have a really special environment in the West where the Silicon Valley crowd are really subject to groupthink and subject to social media influence. And so once we started having influential investors tweet, get your money out of Silicon Valley, there was a huge rush. And once that started, the story started getting carried that, my God, there's something wrong with small banks, as opposed to there's something wrong with the bad management at Silicon Valley Bank or the bad management at the crypto banks that are specialized in highly volatile industries. And I think that story got so exploded into the point where Janet Yellen and FDIC and the Fed all came out and said, we're going to have a blanket new borrowing lending facility to give liquidity to small banks. Well, not all small banks needed it because it was really the specifically
Okay.
badly managed banks that were not well supervised that needed the liquidity.
Bill, we'll be talking about the postscript and doing the autopsy on this for a long time. In the meantime, a lot of people are trying to game out how much lending standards are going to tighten, how much you're going to get a restraint, particularly with respect to the credit available to smaller businesses. Do you have a handle on this, especially at a time when a lot of people say we're not seeing it yet in empirical data?
You know, when I was at the New York Fed back in the 80s, that was one of the things that President Corrigan was obsessed with, which is how much does lending by banks affect the economy? And the studies back then in the 80s, where banks were much more influential than they are now in terms of determining where the credit flows are going, we said that it was really inconclusive, that bank lending hits small businesses and specific sectors hard, but most of American industries and American businesses raise money through the capital markets. And as long as capital markets are able to keep the money flows coming, we won't have a crashing kind of effect on the U.S. economy. And I think that conclusion still holds today.
So if you conflate that, or if you bring that over, not conflate, but if you bring it over to what this means for monetary policy, are you worried that this Federal Reserve and even potentially the ECB, despite some of the hawkish rhetoric, will move away too quickly from the rate hikes, will follow the markets into rate cuts at a time when perhaps this economy is more resilient than people think, even with some of the banking stresses?
Well, I think there are some sane voices on the FOMC. I think Susan Collins, who you're going to have on later, has also said that we will continue to raise interest rates because we need to fight inflation, and we'll worry about the economy as it comes along. And if there is a sign of a credit crunch, we'll address it with supervisory. These are my words now, with improved supervision and specific bank policies, not monetary policy. And I think that's the right way to go. And I think one of the things that we have to keep in mind is that failed supervision should not be interfering with monetary policy.
Bill Lee, thank you so much. With the Milken Institute, as he prepares with Mike Milken for that soiree, I'm sure Bloomberg will have coverage. We don't go to that. It's too early in the morning.
It's too early in the morning.
Nobody, Bill Lee's the only one that'll get up for us at 4 a.m. in Los Angeles or whatever it is. Bill Lee there, just absolutely exquisite with his IMF thing. Let's talk about